Hello and welcome to Trading 5 Talents. In today's video, I want to introduce a new Iron Condor strategy that is really easy and it seems very consistent so far, and it's going to be called the 532 Iron Condor strategy. So the way that this strategy is set up is that we're going to be using wide wings and a wide profit range. So it's different than the previous strategy that I introduced using the tri-weekly Iron Condors, but we're going to be looking for 5 deltas on the short strikes. So those are your 2 middle strikes of your Iron Condor. Then we're going to be purchasing options that are 3 strikes further out of the money than the short strikes that we just sold. So again, this is already different than the previous Iron Condor strategy, but 5 deltas and 3 strikes further out. We'll enter Monday, Wednesdays, and Fridays for 2 days until expiration. So we enter Monday for Wednesday, we enter Wednesday for Friday, and then we enter Friday for the following Monday. And when we enter these Iron Condors, we're entering for approximately 16 cents in credit, so that would be $16 per Iron Condor. So this is why I'm calling it the 532 Iron Condor strategy, 5 delta, 3 strike widths, and then 2 days until expiration. So let's take a look at the chance of profit. We have 5 deltas on the short strikes. Therefore, the Iron Condor should have about a 90% chance of profit. So if we take a look at this schematic of the Iron Condor, we have the call credit spread off to the right. And if this is a 5 delta on the short strike, that means it's going to be a 95% chance of profit, roughly. And then on the put side, again, with that short put having a 5 delta, 95% chance of profit. Therefore, we should have a 90% chance of profit of the entire Iron Condor. That is a 90% chance that the price is going to stay in between our short put and our short call. So to break it down even further, if you remember this graph here, Iron Condor is at the bottom, 95% on the short call side. There's a 5% chance that the price is going to be beyond or above that short call. So that's the 5 delta metric. On the put side, 95% chance of profit. That means there's a 5% chance that it's going to be in the money, or the option will be in the money. So we have 5% risk on that side as well. So 100 minus 5 gives us our 90% chance of profit for this particular Iron Condor strategy. So let's take a look at the profits and losses, or potential profits and losses, I should say. The profits are going to be around $16 per Iron Condor. This is the credit that you're going to initially receive, and that number, or that amount, is based on the Qs that I've been testing it on. So QQQ, which is the ETF that tracks the NASDAQ. And this is going to be requiring $300 in collateral per Iron Condor, because remember, these are 3 strike wide wings. Therefore, you're going to need $300 in collateral. So 16 divided by 300, that's going to be about a 5.3% return on your risk. But what we find, even though that they are smaller profit, $16, they are very consistent, at least in the testing that I've been doing. Granted, it's not a large data set, but it is a very promising strategy. So you can always scale up to sell more Iron Condors for more profit. So instead of trying to gain more premium from a single condor, just sell more condors, and then you can get the profit that you're looking for. With this, though, so even though you're using $300 as collateral, I don't ever expect to take that potential max loss, which would be the $300 minus the $16 in premium that you received. I don't ever expect to take that max loss. Instead, I'm actually going to sort of set a mental stop loss. I'm calling it the actual max loss rather than the potential max loss, because I'm not expecting this Iron Condor to expire with one wing expiring in the money and receiving that max loss. So the actual max loss, what I'm doing is I would be exiting when the underlying price of the stock, or the ETF, or the Qs in this case, when that touches the short strike. All right, so how do we figure out how much that's going to be? Well, we're going to be using option strat in order to figure that out. So let's take a look at Robinhood first so we can see how this Iron Condor is set up. So I've been testing it with the Qs. So it's just QQQ, that's the ticker symbol. And it's after hours right now, but we can still set up the trade just for an example. So this is not a trade recommendation. I'm just showing you how I would set it up. So I'll go to trade and then trade options. And today's Friday after market, so I'll be going for the Monday expiration, which would be October 26th. So we'll start with a sell. So in this case, it's going to be sell put. And then we go to the 5 delta, and the 5 delta is going to be roughly 95% chance of profit. So let's take a look at the 258. So we'll tap on the 258 and we can see the delta's 489. That's really close to 5. Let's just take a look at the 257 just in case. That is 427. That's going to be too low. Let's take a look at the 259 and we see that is too high. That's 582. So we're going to go with the 258, which had the delta of 489. So we're going to sell that one, and then we're going to buy a put 3 strikes further out of the money. So 258, 255 would be the one that we purchase. All right. Now let's go to sell call, and we're going to look again for a 95% chance of profit. We see this one, 291. So 291 has a delta of 544. That's good. Let's take a look at this one here. This is 451. So let's go with a 544, which is the 291. And so we're going to sell this one, and then we're going to buy one 3 strikes further out of the money. So 291, that is 294. So 3 strikes out of the money. So take a look at the review page, and you can see that this is an iron condor. We see all of our strikes here, and we could see that this one is going for 19 cents. So if we take a look here, you could see that this, profit loss graph isn't that exciting. In fact, there's a lot more loss because, we're getting such a small profit, small premium. However, we're not expecting to take that max loss though per iron condor, and I'll show you that in just a second. But this is how I would set it up. So if you tap on review, you can see again for anywhere from 19 to 25 cents. I usually go with the lower bid just for a faster fill. Otherwise, these might take a longer time to fill if you're trying to fill it at the mid price. So in any case, I've been seeing the iron condors going for around 16, 17 cents. All right, so with that said, let's go take a look at option strat. So before we do that, let me show you how much these are. So if you can see these, it's a 10 cent and a 20 cent on the call side, and it's a 22 cent and a 13 cent on the put side. Those numbers are going to be useful when we go to option strat. Okay, here we are in option strat. Come up to build and then build an iron condor. And we need to change our ticker to the Qs. All right, and we want the October 26th expiration, and our strikes in our example on the call side, we're selling the 291, and then we were buying the 294. On the put side, we were selling the 258, and we were buying the 255. All right, now let's take a look at the prices here. So for the 255 long put, this was 13 cents. So I'm going to make this 13 cents. For the short put, this was 22 cents. So I'm going to make that 22 cents. For the short call, this was 20 cents, which is 20 cents. And for the long call, this was 10 cents. So let's make that 10 cents. All right, so here again is our $19 in credit, max loss $281. Now, if we just look at the graph, this is going to be very similar to what we saw in Robinhood. So if we narrow this chart range, you can see that it's the same as Robinhood. But to find the actual max loss that we would take on this trade, I'm going to go over to the table and go back just to resetting the range to approximately where it was before. So here is how I determine that actual max loss. So this is the mental stop loss that I have. I find out when the price is going to touch the short strike on either side and find out what is the potential or what is the loss the day of, or the day that I'm opening it. Okay. So in this case, 258. So I need to adjust the chart range until I get to 258, which is right here. So $103 down here. You can see that the first loss. So if the price touched the short strike as soon as I open this iron condor, that would probably be the most that I'm going to lose, because theta decay is working in our favor for short iron condors. So you can see this 103, it goes down as time passes. As we get closer and closer to expiration, which is moving to the right on this table, it goes down. So that biggest loss, if everything else is equal, that biggest loss is going to be as soon as we open it. So this is why I'm looking at this first column. So $103 on the 258 side. Now let's look at the 291. So if we just adjust this till we see a 291 right here, 104. Okay, so the first one, 258 was 103. This one's 104. All right, so I'm going to say I choose the worst of both of them. So I'm going to say that I'm either going to make $19 or potentially lose $104 if things went really bad as soon as I open this iron condor. All right. Otherwise, as I hold the iron condor, my losses go down as long as it stays somewhere between the short put and the short call. So that is my actual max loss that I'll be using as my stop loss. Okay, so I'm not going to take the potential max loss, which is 300 minus the premium, but the actual max loss is when the underlying touches one of the short strikes the exact time that you open up the trade, which is highly unlikely. So again, I'm using option strat to determine what that loss would be. And I have a video on option strat if you want to take a look to see how to use that. It's a free resource that you can use to test out your option strategies. All right, so when would I exit? Well, I am going to, in my testing, just let it expire. And so that's the ideal scenario. They both expire worthless and you just keep the full premium. So as long as the price stays far away from the short strikes, or at least a couple of dollars from the short strikes, on Robinhood, you're good. If it gets too close, Robinhood might actually close it a little bit early. And then what I do is I enter the next iron condor before the first iron condor expires. So I've been entering anywhere from 2 to 2:30 Eastern time. So about an hour and a half to 2 hours before market closes. That's when I'm entering these iron condors. This does require more capital because your strikes are wider. So remember, $300 per iron condor. So the other scenario is exiting this iron condor early. And if you're losing when that underlying price touches the short strike, that's when you would exit for a loss. And what I've been finding on average, the actual max loss is about $115 per iron condor. Of course, it changes based on volatility, but that's what I've been seeing. It's around $115. You might also want to exit early when it gets down to 5 cents, 4 cents, 3 cents. What I've been finding trouble with is exiting when it gets down to a penny. There's no market for that. So no one wants to be on the other side of that trade. So I've just been letting them expire. So why do I like this strategy? Well, for one, it has a high chance of profit. I mean, you have a 90% chance of profit as opposed to the other iron condor strategy I was working with, which was only a 20% chance of profit. So this one obviously is a lot better. You have a lot of winners. So I'll show you in my testing in a few more days. Once that concludes, it's really good for the psychology when you see all of these base hits, all of these small gains adding up over time. It's a very passive strategy because you don't really have to manage it too closely. I mean, there has to be a really wild swing in the market for it to get to your short strike with your strikes so far away from the current price. So it is very passive. These are high ROR trades. You saw it was about 5% ROR, making about $16 and risking $300. Even though you're not risking all 300 because you would exit before you got to that, I've just been using that for the calculation. And you only track one ticker. So you're not, that's with the other iron condor strategy as well. You're not looking at a whole bunch of different tickers. You're just focused on one particular ticker. This is, in my case, it was the Qs. So just looking at the Qs, you know how it behaves, you know its personality, you know its range. So you really know the characteristics of that particular ticker. So I do like an iron condor strategy. It's got simple rules. I know when to enter and I know when to exit. Some disadvantages, however, for this strategy is that if you pay commissions, this is a 4-leg strategy, 4 legs to enter. And if you're exiting early, it's 4 legs to exit. So if you're paying commissions, that really could eat into your profits. The black swan event, this is when there's an unexpected dramatic move in the markets. It could result in the potential max loss. You just were not quick enough to exit it when it touched the short strike just because of a catastrophic move in the market. But I guess in trading, the black swan event is pretty much going to affect any trade similarly. So it's unexpected and it's violent. So, that would be a disadvantage for any investing or trading strategy. Another disadvantage is that because the premiums are so low, exiting early really isn't an ideal situation because, for me at least, to make this profitable or more profitable, more appealing, I would want the entire premium. So I would want it to go to expiration. So if I'm exiting early at 50%, 75% max profit, it might not be worth it. And I might try to look for a different version of the strategy. But in any case, I think there are a lot more advantages to this strategy than to the previous Iron Condor strategy. And I believe there are a lot more advantages to this strategy than disadvantages to this strategy. So in a few days, I will post another video with all of my results from how I've been trading this Iron Condor strategy on the Qs. So you want to make sure that you hit the subscribe button and turn on the notification so you know when that video comes out. And if you have any questions about this strategy, please leave a comment down below or catch me on Twitter at Trading5Talents. In the meantime, trade wisely and take care.